Australians have more than $3 trillion invested in superannuation. So are we getting bang for our buck when it comes to our retirement nest egg? For the first time, the nation's financial regulator, APRA, has examined the performance of 76 super funds. 13 have failed the test, including AMG, MySuper, Commonwealth Bank Group Super, Colonial First State and Maritime Super. Let's find out more with our finance expert David Sharpe from Globe Financial Planning. David, the assessment found $56 billion is invested in these underperforming funds, which hold almost 1.1 million accounts. Now, how concerning is this?
Look, I think it's really important to add some context as to what the findings that came out today are. What APRA, the regulators, looked at is the MySuper product or the investment options within these super funds. So it's not necessarily the super funds that are bad, it's their MySuper product offering that is poor. And look, that's the offering that is the default option. If you don't tell your employer where you want your money put into, this is where it's going to be directed. And so some of these super funds can have hundreds or dozens of different investment choices. So to give you an example, Retirement Wrap, which is a Westpac product, has one MySuper product which is in the top 10 and another one which got a warning today because that's in the bottom 13. And so I know that sounds really confusing. So the simplest analogy I can give is imagine you're comparing super funds. What APRA's done is gone, well, it's too hard to compare all the products. Let's look at the home brand milk and bread only and make our comparison. Now, that might sound a bit glib and you might go, well, what's the big deal if it's just that? Well, the big deal is, as you mentioned, there are millions of Australians and there are hundreds of billions of dollars invested in these default options. And if they have poor performance, those people are going to miss out at retirement.
So these are the default super funds?
Correct.
The ones that your employer chooses?
If you don't choose yourself.
What's happening with these funds now?
Well, they've got a couple of things they're going to have to do. They're going to have to write out to all their members and explain that they've failed this persistently poor performance and direct them to the government's super comparison tool. They're also going to have to deal with APRA and they're going to have to explain how they're going to turn things around. And effectively, the trustees have got to decide, are they going to shape up or are they going to ship out? So they'll be madly scrambling, trying to work out how can we get our return up, or should we exit? Because if they get a second warning, they are going to be closed to new investors. That's what the death knell for a super fund. And 8 have already seen this writing on the wall and are already out as well, in addition to the 13 that were poor performers.
Why should we do our own checks on our super funds, even if they're not on this list?
Yeah, well, look, I feel like I bang on about this all the time, but ignoring your super comes at your own peril because a 1% difference over a working lifetime is literally going to mean hundreds of thousands of dollars at retirement. That's going to mean cars, holidays, dining out. That's what paying a bit of attention means.
OK, and finally and quickly, what are your tips this week, Sharpie?
Well, I often talk about performance, but if you're approaching retirement or in retirement, you should be looking at risk as well, not just the best performance. Be deliberate, not just default when it comes to your investment strategy. And when you are looking at your strategy, think long term, not just what's happened in the last 6 or 12 months. Think about the next 10 years.
Always appreciate the insight. Thanks, Sharpie.
Thanks, Monica.